Hello guys. So today we are going to discuss how interest rate. We normally hear in news that the central banks like RBI has raised the interest rate, how it affects a normal individual, how it affects the companies, and what is repo rate all about. So before starting this video, I am trying to just tell you how these interest rates affects the economy, a normal individual, and the companies overall, and the overall economy. So before jumping in, I would like to explain you what repo rate is all about. So repo rate is a rate at which the central bank, which in case of India is Reserve Bank of India, lends money to commercial bank and financial institutions. So commercial banks are like HDFC, ICICI, SBI. So for example, for short term, these companies take money from RBI because RBI is the central authority to print currency in India. So when they raises the interest rate, so the rate at which these companies takes loan from central banks also increases. And when the rate increases for these companies, the cost of borrowing is increases, they are definitely going to pass this cost of borrowing to the customer. The customer can be a normal citizen of this country, the retail customer, and also it might be a corporate giant. So for them also the interest rate increases. So their payment liability in terms of the EMI they are going to pay will also increase. So, and when RBI slashes the rates, which is the repo rate, it expands the economy because the money supply will increase because the rate will be less. If you see the data from 2020 till 2022, and you see that currently it's 6.25 in December 2022, and it has increased from 4%. So around 2.25% rate jump has been there. So definitely there will be a cost incurred on companies and normal citizens when they buy loan. So they might delay their decision, a lot of decisions. So before moving further, I would like you to watch this video.
So just why do central banks raise interest rates to curb inflation? Central banks are public institutions. What does that mean? They are non-commercial and independent entities regulating banks. These banks are tasked with managing the currency of any country. And in the case of the European Central Bank, it is the currency of 19 countries. The sole mission of central banks is to ensure that prices remain stable. So when the prices go up or down, the central bank gets to work. And when the prices go up, it is called inflation. Usually all central banks have a target of moderate inflation. The rate is usually between 2 to 4%. This is known as positive inflation, used to ensure growth. But when it goes above that, that is when the alarm bells start ringing. Excessive inflation is when the central bank jumps in. Now we know that.
So as it is explained in the video, when the inflation rate is very high, in order to curb the liquidity in the market, the central bank raises interest rate. And currently globally there is a lot of inflation. Though it has been in control in India, but globally central banks are raising the interest rate in order to control the inflation. And now these interest rates are decided by the repo rate. So I am going to talk about how repo rate increase affects the individual. So as and when the interest rate rises, people might delay the decision. For example, buying automobile. They want to buy car, they might delay it because they know they have to pay more EMI. Buying houses, going for higher education, because they might have to pay higher EMI. That's the simple logic. And what is the overall effect of interest rate change? As interest rate increases, the cost of borrowing becomes more expensive. And this makes buying certain goods and services such as house and car more costly. So there will be a delay by a retail customer as well as companies taking new decisions. Moving on, how interest rate, that is the repo rate, affects companies when it rises. So if your business has an outstanding line of credit, that means if your business has a debt, so there your interest rate you have to pay might rise because of the rising interest cost. Also, your company might think that if they want to open up a manufacturing plant, or they want to expand the current manufacturing plant, they might think of delaying it because they need to buy loan from the market, and that is costly as of now. Similarly, for smaller businesses that takes a lot of loans to run their day-to-day cycle, and they might not be possible for them to pay such huge EMI. So some of the businesses might shut down, and small businesses are affected more because of the rising interest rate, because a lot of big corporates have huge cash savings because they are big names in the market. So this is how repo rate affects individual companies and everyone in the economy. So that's from me from today's lecture. Have a good day.